If you can't get 100% of your money back from a bank according to the terms you opened the account under, then that is a bad bank. In 2024, are there any bad banks? It has been a long time since the term a bank run has made the news, though there are occasional news items on bank failures that usually don't entail long lines of people trying to withdraw their money. Moreover, that is because to a significant extent people do get their money back. How is that? Because the banks have acquired governmental insurance from the Federal Deposit Insurance Corporation, FDIC. The website https www.fdic.gov gives the following information. The FDIC is an independent agency created by the Congress to maintain stability and public confidence in the nation's financial system by insuring deposits, examining and supervising financial institutions for safety and soundness and consumer protection, making large and complex financial institutions resolvable, and managing receiverships. Deposit insurance is a fundamental component of the FDIC's role in maintaining stability and public confidence in the U.S. financial system. By promoting industry and consumer awareness of deposit insurance, the FDIC protects depositors at banks and saving associations of all sizes. When these IDIs fail, the FDIC ensures that the customers have timely access to their insured deposits and other services. The basic limit of federal deposit insurance coverage is currently $250,000 per depositor. In the event of a bank failure, the FDIC covers all the losses of the bad bank. Prima facie, this sounds like a good thing so bank customers do not get defrauded or stolen from. However, it also lessens the responsibility of bank customers from learning the difference between a good and bad bank and choosing to patronize good banks. What business should the federal government have in making good on the losses of bad banks? The banking crisis. The banking crisis of the 1980s and 90s was the greatest challenge the FDIC has ever faced. The crisis had four main causes. Boom and bust economic activity occurred in certain regions and economic sectors. Legal restrictions on bank branching made banks more vulnerable to regional and sectoral recessions. Many banks exhibited weak risk management, and appropriate government policies such as less frequent bank examinations also played a role. These terms, weak risk management, appropriate government policies, and less frequent bank examinations, are moot when a bank is good and its customers have a strong contract for doing business with them. The Federal Savings and Loan Insurance Corporation, FSLIC, was an institution that administered deposit insurance for savings and loan institutions in the United States. In the 1980s, during the savings and loan crisis, the FSLIC became insolvent. It was recapitalized with taxpayer money several times, with $15 billion in 1986 and $10.75 billion in 1987. However, by 1989, it was too insolvent to save. The Financial Institutions Reform, Recovery and Enforcement Act of 1989, FIRREA, abolished it and transferred the responsibility for savings and loan deposit insurance to the Federal Deposit Insurance Corporation, FDIC. What's shuckin' and jivin'? How can a federal institution go insolvent without the federal government going insolvent? Are we to be painted as slack-jawed yokels who watch the nameplates change and the hot potato juggled from one Byzantine agency to another without demanding prosecutions? How many times and to what extents has the FDIC had to cover the failure of banks? Taking a look at the chart, there is the numbers up till 2017. 2010 it was 157, quite a spike there after 2008. And looking at the chart up to 2024, there have been a couple years with some zeros, which was good. And I don't think the number's gotten over 10, not too high over 10 on any of the other years. But all of those banks right there, if a bank fails, That's one thing. Businesses fail all the time. But if you don't get your money back, um, that's fraud and theft. And it's not the government's responsibility to be engaged in private business. Looks like there have been lots of bad banks over the long time, and the cost in some years runs into the billions of dollars. And how many of these bank and thrift failures were criminal charges filed? That is a salient point concerning morality and ethics. If the FDIC covers all failures, with the source of that money being dubious, fiat and debt-based, and there is no discernible punishment for criminality, then there is no standard for badness. Everything comes out good, and that smacks of utopianism. It is also interesting to note from 1934 to 1979, about one half the lifespan of the FDIC, there were 558 bank and thrift failures. And from 1980 to 2018, there have been 2,065 bank and thrift failures. Quite a substantial increase in failures since 1979. And mind you, this is the era of a heavily inflated monetary system. There are trillions more dollars in circulation now than there were in 1979. Everything should be supportive for having good banks, but there is a substantial increase in failure, and the utopian capability of the FDIC makes there seem like there are no bad banks. The above screen print was taken from 2008 FDIC annual report. Good Lord, are they seriously bragging about having zero insured depositors' dollars lost? They have access to practically unlimited funds. Think TARP 2008 of the federal government, and they want to brag about covering over the failures of bad banks. And that raises another point. Something was indeed lost. The taxpayers fund and cover what the FDIC pays out, either with current tax money or when the Treasury bonds to cover deficit spending are paid with future tax money. Taxes are a loss to private citizens. Let us chase the rabbit. A person pays taxes. A person opens a bank account and deposits their money. The bank fails. The FDIC covers the bank failure, paying bank customers with money the federal government got from the bank customers via taxes in the first place. What a racket. FDIC insured institutions closed during 2017 all over the country. Concerning bad banks and their failures, how many times have you seen a bank outright shut down and close their doors? Not very often. What is more commonly seen are banks changing names. I know presumption has always been upon a bank changing names was the bank was purchased by another bank. The above graphic taken from the 2017 FDIC annual report shows that when a bank fails, the FDIC covers the shortcomings on deposits, and then another bank takes over via receivership. That failure of the Guaranty Bank, Milwaukee, Wisconsin, with 287,742 deposit accounts, looks like it turned out to be a big bad bank. But I forgot myself. With the FDIC, there is no such thing as badness, especially when a taxpayer will chip in. Another facet. How many people engage in authoritarianism, vice, and sin profit from the behavior of these bad banks, and then get away scot-free with their ill-gotten gains when the bank fails, right in front of our faces? And remember, a person making $100,000 a year anywhere in this process, let alone bonuses, without any other profit, once the bank fails, that yearly wage was an ill-gotten gain. What happens when a bank fails and there's no other bank to step in immediately for receivership? The FDIC takes possession of the bank and its assets until it can liquidate them. The below is a very interesting and disturbing graphic taken from the 2008 FDIC annual report. Unusual holdings. When a bank fails, the FDIC often winds up acquiring some of the institution's assets. Throughout the years, the FDIC has temporarily owned some highly unusual businesses and properties. typically the result of bad loans or investments made by failed banks. Take a look at some of our oddest acquisitions: the Dallas Cowboys, citrus and almond tree farms, taxi cabs, ghosts and ghouls, abracadabra, Grizzly 2 the Predator, that's a movie, from oil tankers to shrimp boats, race horses, Las Vegas casinos. Should the government really, in any situation, end up owning those things? So the FDIC, and by association the federal government, has been involved in ownership, full or partial, for a period of a professional football team, farms, taxicab, movies, boats, racehorses, and casinos. What are the implications upon private property with this aspect of the FDIC? Are we witness to the fact that monetary policy can be tweaked to drive banks to failure, allowing the FDIC and federal government to acquire private property in all its forms? What if the Federal Reserve constricts the money supply? How much and what exactly will the FDIC come into possession? Everything? Consider this post on CNBC.com on 3/8/2018. J.P. Morgan co-president warns of deep correction for stocks totaling as much as 40% over the next few years. The equity market has some way to go for the next year or two, said J.P. Morgan's Daniel Pinto, but then if there is a correction, it could be a deep correction. How many banks are going to fail over the next few years? How many unusual holdings will the FDIC pick up? As of September 30th, 2017, the total number of insured institutions on the FDIC's problem list, institutions with the highest risk rating, totaled 104, which represented a decrease of more than 88% from December 2010, the peak year for bank failures during the financial crisis. What spin? To try and make 104 banks on the problem list look prudent by saying the number is 88% less than the peak year of bank failures in 2010. I feel warm and fuzzy knowing that statistic. The below cartoon was published in the FDIC's 2008 annual report. The Family Circus. Daddy, what does FDIC mean? That's the Federal Deposit Insurance Corporation, where the United States government protects our money in a bank. And then the little boy's got a piggy bank with FDIC written on it. Only the credulous would not ask, what bank? A private bank? If so, aren't they capable of protecting their customers' money without the government intervening? Insurance is the antonym of gambling. By implication, if a bank needs insurance, whether privately or the FDIC's governmental FDIC, it is doing something risky. A definition of gambling is to put money at risk. A definition of insurance is to mitigate risk. If you deposit your money in a bank that needs insurance, you should pay attention to the terms under which that bank operates. As of September 30th, 2017, the FDIC insured $7.1 trillion of deposits at 5,746 commercial banks and thrifts. And none of that would have been necessary if good banks were patronized and bad banks faced criminal charges upon failure, exponentiated by the number of customers they defrauded or stolen from. So a little update in 2024. Like I said, there have not been any great increase in the number of bank failures, which some of the people in charts were worried about. But in that time frame, the money supply, treasury bonds being issued, went from about 18 trillion all the way up to 34 trillion. So while the banks have not on their own failed, let's just say that if the money supply had stayed the same in 2017, 2018, no great increase of banks have failed, but the amount of money in the system flowing through all the accounts based on treasury bonds being issued to acquire Federal Reserve notes from the Federal Reserve has just about doubled. A 100% increase in debt. So that's like jet fuel being pumped into a jet engine. It's keeping the jet alive and flying. But how long that will occur and what are the bank records when the jet fuel ends remains to be seen in the future. But the fact that there are bad banks means that there are good banks, and a person should mind their own business and learn the difference, and of course, to choose to do good.